What's driving markets? Welcome to Market Take. Each week we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Jean Boivin, head of the BlackRock Investment Institute. This week I'll discuss how the demographic megaforce is creating structural change across countries and sectors. The number of people of working age is shrinking across developed markets, but still growing in emerging markets. Demographic divergence is a megaforce or a big structural shift that we see driving sector and company dispersion. By 2050, 1 in 6 people globally will be over the age of 65, up from 1 in 11 in 2019. In developed markets, fewer workers mean slower economic growth, higher inflation, and increasing debt due to healthcare and pension spending. Japan has somewhat lessened the impact of its unfavorable dynamics by boosting its female labor force participation rate by more than 10 percentage points since 2010, International Labour Organization data show. The recent immigration surge in the US, UK, and Canada is also boosting the workforce, but it will have to persist for years to completely offset working age population declines, unlikely in our view. We're monitoring how much investment in automation and artificial intelligence can boost the productivity of a smaller workforce. We seek out opportunities in countries that adapt more effectively than others and could outperform the growth outlook markets have priced. Including more foreign workers, women, and people over 65 in the workforce can offset some of the impact of aging, but not completely, we think. That means slower future growth in developed markets. Instead, emerging markets like India and Mexico could benefit from a working age population that is still growing. We also seek out emerging markets that have room to improve labor force participation and are set to ramp up investment in productive capital like public infrastructure. Rapid population growth drives up energy demand, so we expect greater spending on energy infrastructure in places like India and Indonesia. We think emerging markets with stronger growth and greater investment should produce higher returns. Older populations spend differently than younger ones. That changes the outlook for individual sectors and companies. Markets are typically slower to price in those shifts than the broad country growth outlook. For example, healthcare valuations in Japan have risen only as their country's retired population has grown. Real estate demand could also change since older people typically move less frequently. An investment in automation to boost workforce productivity should benefit names tied to our AI megaforce. We prefer developed markets that are better adapting to aging and emerging markets capitalizing on younger populations. We lean into sectors like healthcare that stand to benefit from new spending patterns. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcast.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com